Did you know that during the 2018 bear market, Bitcoin's price bottomed out at $3,200 just months after the fear and greed index hit an extreme low of 5, reflecting utter panic? Yet, within a year of the 2020 halving, it surged past $50,000. Today, with the 2024 Bitcoin halving on the horizon, and as we navigate yet another brutal bear market, the question looms: will history repeat itself, or are we in uncharted territory? Welcome to the Financial Reality, where we cut through the noise and dive into the data. Let's unpack the patterns of Bitcoin halvings and their impact on price cycles, especially during bear markets. First, let's set the stage. Bitcoin halvings occur roughly every 4 years, slashing the block reward for miners by 50%. This mechanism, hard-coded into Bitcoin's protocol, reduces the rate of new supply entering the market, historically acting as a catalyst for price appreciation. We've seen 3 halvings so far: 2012, 2016, and 2020. Each has been followed by a significant bull run, though the timing and magnitude vary. According to CoinGecko data, post-2012 halving, Bitcoin rose from $12 to over $1,000 by late 2013. After 2016, it climbed from $650 to nearly $20,000 by December 2017. The 2020 halving saw Bitcoin move from around $8,700 to a staggering $69,000 by November 2021. But here's the critical point. These rallies often emerge from the ashes of bear markets, where sentiment is at its lowest. Now, let's dig deeper into the data and patterns, particularly during bear markets like 2018 and 2022, to see how halvings interact with price cycles. In 2018, Bitcoin crashed over 80% from its $20,000 peak, bottoming at $3,200 in December. On-chain data from that period shows transaction volumes plummeting and the Relative Strength Index, or RSI, dropping below 30, indicating oversold conditions. Fast forward to the 2022 bear market, following the 2021 peak of $69,000, Bitcoin fell to $15,500 by November, again with RSI readings below 30 and the Fear and Greed Index hitting extreme fear levels around 10. Market cap shrank from over $1.2 trillion to under $300 billion per CoinGecko, reflecting mass capitulation. What's fascinating is that in both cases, the subsequent halving, 2020 for the 2018 bottom and the upcoming 2024 for the current cycle, marked a turning point. Historical patterns suggest that bear market lows often occur 12 to 18 months before a halving, followed by accumulation phases and eventual parabolic runs. So, where are we now as we approach the 2024 halving, expected around April? At the time of recording, Bitcoin hovers around $26,000, down over 60% from its all-time high. Daily trading volume, according to CoinGecko, has dropped significantly from its 2021 peaks of over $100 billion to under $20 billion on many days, signaling low retail interest. The Fear and Greed Index sits at 40, indicating neutral to fearful sentiment, while RSI on the weekly chart is around 45, neither overbought nor oversold. On-chain data shows long-term holders accumulating, with over 70% of Bitcoin unmoved for at least a year, per Glassnode metrics. If history is any guide, this could be the quiet before the storm. The 2018 and 2022 bear markets Both saw similar stagnation before explosive moves post-halving. However, macro conditions, rising interest rates, inflation, and geopolitical uncertainty add a layer of complexity that past cycles didn't face to this degree. The data shows potential for a repeat of history, but not without risks. What does this mean for the broader market and investors watching the 2024 halving? First, if the pattern holds, we could see Bitcoin test lower levels, potentially $20,000 or even $18,000, before finding a firm bottom in this bear market. This aligns with historical drawdowns of 80 to 85% from peak to trough. Second, post-halving, reduced supply pressure could reignite demand, especially if institutional adoption continues. Think of firms like BlackRock pushing for Bitcoin ETFs. But let's be clear, timing the exact bottom or top is near impossible. The data suggests opportunity, but macro headwinds could delay or dampen the expected rally. Investors must also consider miner dynamics. Post-halving, smaller miners may struggle with reduced rewards, potentially selling off holdings and adding short-term downward pressure. The key takeaway? Bear markets are painful, but they've historically been the breeding ground for the next cycle's gains. Patience and data-driven analysis are paramount. If you're looking to navigate these choppy waters with precision, I've got something for you. Sign up for the AI Signal, our free daily trading signals newsletter. It delivers exact entry points, RSI levels, and key support zones straight to your inbox, helping you make informed decisions based on real-time data. The link is in the description. Don't miss out on this resource as we approach the critical 2024 halving. Let's stay ahead of the curve together. Thank you for watching The Financial Reality, and I'll see you in the next video.